So when we talk about the Ethiopian banking sector as we know it now, it's 25 years or less since its existence, with the first wave of liberalization of the financial sector. As I said before, during the Derg, we took all the private banks we had before, including all the foreign banks, and government made them all one bank. Banco di Roma, all the different banks became commercial bank. Nobody built the commercial bank of Ethiopia. Nobody built this big bank. Government just acquired all the banks and put them together and said, here's the commercial bank of Ethiopia and it's mine. Okay, so we had that for like 20 years. Then the new administration came. We liberalized. That was a liberalization. We went from state-owned banking sector to private banks. Not foreign private, but private banks. So the banking sector and a lot of what we see as inadequacies come from this infant industry. On top of infant, closed. If we'd opened up back then, we would have a different banking sector than we have now. So we had to bootstrap everything, so it's slow. And again, for all the environment we're in, compared to other African banking sectors, we're backward. There's a reason for it. And the reason is this. Infant industry in a closed, isolated market where the rest of the world is zooming by. So we're left behind. It's a policy problem, which is now being addressed. So that's one. Number two, the banking sector is as close a reflection of a country's economy as anything else. Because what do banks do? They collect money from the economy, and they channel money into the economy. So banking sector performance is, depending on their portfolio allocation, reflects agriculture, industry, services, everything. So when we look at the Ethiopian banking sector, over the last 24 years, it's been like the most attractive investment sector of any domestically. Why? Well, it's paying really high dividends. How come? I'll come to that in the presentation. But it's collecting economic rent, which basically means supermarket profits because of inefficiencies in the market. Who's paying this? The public. Does it make sense? No. If you were a shareholder in a local bank, or if you were a local bank CEO, would you want this thing changed? No. Does everybody else want this changed? Yes. Change always has winners and losers. There are vested interests in the existing whatever it is. When change comes, they lose, but everybody else gains. So as a government, your policy priority is to figure out what's important and to make sure that we're serving the mass public. So the reason I wanted to go back to the macroeconomic numbers is, in spite of everything we're saying, they're not serving the market, they're not doing this, they're doing, how come they're making all this money then? Okay, how come they're growing so fast? They've grown. Well, what allowed this is the macroeconomic context. When you have an economy that goes from 4 billion to 100 billion, and the monetary flows are going in the same direction, and this growth is being financed by monetary expansion from the state. Okay, where is all this money? It's not raining into our pockets or into projects. It's all going through the financial system. So how could they not grow? How could they not be profitable? especially in a protected environment. So, the things you had going for the industry, which I think now are changing, it's an infant industry, and like all infant industries, if it's serving an appropriate market, it's going to have an easy growth spurt, the low-hanging fruit, which they did. And then they were in a macroeconomic environment where it was raining money. So deposits were not a problem. And you have an economy that's growing, a lot of borrowing from the state, but private sector as well. So borrowers were lining up. Bank management had their feet up on the desk, and it was just printing money because they're in the middle of this huge flow. So when we look at, especially since the last 17 years, GDP, all that growth, it was easy times for the banks. What's happened now? Well, the economy is not doing so well. The banks are starting to feel the pressure. Okay, when I say the economy, inflation is, nominally good for banks. There's more paper coming in and more paper going out, and nominal income is great. But what's worrisome for them is the GDP growth. And even the monetary expansion at some point has to ease off. So the cooling of the economy, what does that mean for banks? Okay, should be less loan demand. But more importantly, non-performing loans, I think, probably are and could become more of an issue. We've kind of plastered over that with accounting. Okay, so the environment where money was just flowing in, the economy is growing, everybody's doing well, now has reversed. The other key driver, let's skip to the next chart. This is just over the last 10 years or so. The history before was, was all up and up. So the top performing bank, look at the earnings per share they were paying. 2013, they had a 70% dividend. That's unheard of. Monopoly rent. And then it comes down, and it's still up above 50. That's the top performing bank. Look at the average. You're in the high 30s, 40s. And then the lowest performing bank is still managing to pay 20% dividend. That's not normal. For a sector that we all admit is not doing what it should be doing, what it shows is you have this big economy that has massive demands for banking services, has limited supply, and the guys in the middle have been collecting economic rent. But then now you look at 2021, the changing economy, the weakening economy, and you look at the average, it's kind of starting to trend down. These numbers are actually misleading. Like I said, if someone came in and actually did a proper audit and looked at, especially the non-performing loan issue, I don't think we'd be seeing these numbers, but we'll break down kind of where they make their money. So red line is loan growth. Average earnings per share is that line in the middle. But then look at the blue line, which is Forex transaction volume. What does that mean? That's the other big part of banks' income. How do banks make money from foreign exchange? So an exporter or some service, whatever, they get foreign exchange. Then they open letters of credit for importers. So the volume of income they get from that business is directly related to how much foreign exchange they're able to collect and is available for them to open letters of credit. And look at the trend line on that. 2021. We've entered negative territory. It's not growing, it's negative. Okay, so that has, that was another big driver of income. Not only was the volume up before, I remember when we started Zaman Bank, like 15 years ago. the average fee that banks would charge to open a letter of credit was 0.5%, 0.5%. We came in and said we're doing better service, blah, 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 we charged 1%, and everybody thought, whoa. Nowadays, you have any idea how much they charge? Comes to around 12%. Just for opening a letter of credit for you. Why can they do that? Because there's a shortage of foreign exchange. I mean, it's like, excuse me, but this is like highway robbery. Who pays for all of this? The consumer. The importer doesn't care. He just knows that's his cost of business. He's going to do his markup. And because there's scarcity in the market, he can sell it for any price. This is why, whenever I hear people saying, you can't open up, you want to protect the banking industry. This is what you want to protect. And then no consumer loans. Okay, so where are their earnings heading? You can see the trend line is coming down, and this Forex volume picture is, okay, I don't know when it's going to get better, it might get worse. Their reaction might be to, put the fees up to 15%. Who knows? Maybe they can keep their earnings going like that. So, historically, this sector was profitable because of the macro conditions, the growth, infant industry, the Ethiopian economy, infant economy growing up. How could banks not make money? Now the picture has changed. It's kind of growth, GDP growth, as we saw before, has leveled off. It's near zero. We don't know what the number is. Broad money supply keeps growing. I don't know how long that's sustainable. Foreign exchange supplies available to the banks is declining. I'm sure at some point we're going to have to start accounting for non-performing loans. So I think the sector is heading for tough times, unless something changes in the assumptions here, in very broad terms. Next chart. So how have they been making up for, maintaining their profitability? You can see loan growth now is just shooting up. Different sectors, but. So they're trying to maintain profitability by increasing their loan portfolio. We've looked at the average spread, the cost between deposits and lending rates over time to see if that was, with the Forex, the fee, the spread was a big factor above and beyond the volume in helping profitability. On the loans, we don't really see that. So it's being driven by volume. So what does this mean? It's not that their deposits have grown as much. They're leveraging up more, so their loan to deposit ratios are going up. In a declining economy, they're really boosting loan growth in a difficult economy. That might have implications further down the road. So they're pushing to maintain profitability in spite of everything, which automatically means they're pushing their risk parameters as well. So we took we always forget microfinance. No, it's the same. What do? They lend. What do banks do? They lend. They collect deposits. This is the sector that interests me. This is the sector that's serving the mass market. But when you look at it, it's like a fraction of the banking sector. But still, their only income is, they don't generate foreign exchange, so they collect deposits and they make loans. Consumer loans, or SME loans. So when we look at the banking sector opening up, we focus on banks. But we'll get into the discussion, who's coming, what would they want to do, and so forth. This market is the one that's interesting. But this market hasn't been divided. It's not they're coming in to take away business from these guys. This market hasn't been touched. They're going to grow this market. They're going to enable, through digital technology, financial institutions, whether they be banks or microfinance institutions, to supply consumer credit and other financial services to the mass market, which is, to me, just way late, long overdue. Okay? Part of the reason when you look at, in banking, what's the other big business? It's corporate loans, yeah? Big, small corporate loans. Is there a massive amount of unmet corporate loan demand in the economy? To be honest, I don't know, but I doubt that it's massive. But, so what would the foreign banks coming in looking at this sector, what would be interesting about it? What would be the challenges? Their experience and what we've seen from experience in other African countries, I see a lot of recent studies where, people are commenting on, opening up of the banking sector and what it could mean for Ethiopia and all the risks and this and that. And without exception, all of them are based on kind of reviews of the literature, of the experience of other countries 25 years ago. It's completely irrelevant to today, completely irrelevant. What the banking industry was then and it is today, it's like two different worlds. The technology is two different worlds. So why do we think that history has any application here? I don't know. Okay, the way I see it, the recent experience of regional Pan-African banks, kind of what they do in their neighboring countries and new markets they come into, that's the prototype we should be looking at because that's what's going to be. And that's a whole different story, we'll get into it. But it's not the corporate. The people that played that game back then, 25, 30 years ago, 20 years ago, which is, what we find troubling. So all the big banks, European banks, American banks came in, all the big names we know. I mentioned it briefly this morning. HSBC, Barclays, Citibank. They're selling and leaving. Why? Because their business model didn't work. Why? Multiple reasons. But, this corporate lending, Africa is 52 different countries, 55, 54, okay? Each country is a country. Each country has a national bank. Each country has, now they're convertible. Back then, a lot of currencies weren't convertible. And they're small little markets. These are giants. So, having a high margin on like a small piece of business for them is not interesting. Some of these countries, they don't even make decimal point rounding errors in their income. Okay? But then, what happened came, know your customer regulations, money laundering, this and that. So now the regulatory burden for every country they open in, every branch, it's like all of a sudden in head office, they have a whole department that costs more than all the business they're doing in that country. And they basically left. And they're not coming to Ethiopia, I'll tell you that. So, all of these studies that we see about the old experience, and that is that. Has nothing to do with what we should expect today. What we should expect today is what we see happening in Kenya, East Africa, and Nigeria, what the Nigerian banks are doing. What do? We don't have to philosophize. They go after the mass market. And they compete hard. Who benefits? The consumer. Over lunch, I have to thank, who was telling me to use this example? Maybe it was Halawi. What's happened in telecoms is like brilliant example. So, Safaricom is coming. Woo! What's happened? A year before that, what is Telecom doing? They've slashed prices 50%. They're introducing new technology. Someone just told me at lunch, now, to preemptively lock in the market, for 10,000 birr, you can sign up for 1 year unlimited voice and data? Wow, I'm going to sign up. And they're not even here yet. That's the magic of competition. Who's benefiting? All of us. Now we actually have connectivity that works. I mean, it couldn't have been a better example of what competition is. Is this what we fear? If Telecom hadn't taken these preemptive measures and someone comes and takes their market share, their problem, not the country's problem. But they're attacking the problem. They're fortifying their defenses. That's what the banks need to do. The days of protection are over. The days of easy money are over. And like I said, this is the nature of the free market. This is how we get progress. Competition. We're not in the business of protecting individual companies or even sectors. Okay? Like I said, the private sector is the private sector, especially now. Our Kenyan brothers, our Nigerian brothers should have the same opportunities and rights as any Ethiopian businessman here, as we demand when we go to their countries. And what's the risk there? No. Players in the field have a little competition. Who benefits? All of us. For a long time, I know, before the Telecom privatization, the conversation was, Telecom, our national pride. We shouldn't privatize, we shouldn't. Upside down thinking. And it's the same with the banking sector. So the challenge for the banks, for the microfinance companies, is gear up, get ready for a fight, protect your territory. And if you can't, give it up. Don't ask the public to pay for that. It's that simple. That's how you get progress. So in the middle of all of this, are there going to be some losers? Yes. That's what free markets and competition is about. Are there going to be some winners? Yes. That's what it's about. And it's up to you, as a bank, as a microfinance institution, to look ahead, understand what's coming. And it's coming even if we didn't have the foreign banks coming in. Digital revolution is coming. You heard this morning, AII, our friends from Whale Cloud. Okay, the financial institutions that get on board and do what they're, we'll give them the technology. They got to compete in the market. There you go, you have a chance. If you don't, then you don't deserve to have a chance. That's just free markets, how they work. So, with that intentionally provocative intro to the discussion, I could talk a little bit about foreign banks coming in, in a little more depth, who they might be, and so forth. From what I can gather, clearly, Kenya, the East African banks are our neighbors. A few of them already have set up rep offices here, just to get the lay of the land, understand what's going on. They're preparing. They have no business setting up a rep office here if they don't want to be in the market. So they've been here a little early. The banks from West Africa, primarily Nigeria, I think will be very interested in this big consumer market. The other kind of regional Pan-African banks really come out of South Africa and North Africa. North Africa, it's really Algerian, Moroccan banks. I don't think they're going to be big on, they're going to make a big push into sub-Saharan Africa. The South African banks, I don't think they're going to be pushing into maybe they will, but we don't see indications of that. I think they want to protect their southern hemisphere. So I think the dogfight, the real aggressive guys, are going to come from Kenya and East Africa, primarily Kenya, and West Africa, primarily Nigeria, maybe Ghana. But, my friends will correct me. And, what's interesting is these Pan-African banks now are big international institutions. They're not like our banks. These guys can issue billion-dollar Eurobonds, unsecured. 500 million, they can raise that money. That's how strong they are. From capital markets, from London, from New York. That's who's coming. They're African and they know the African consumer. There's a fight coming. So it's really, okay, what modalities? We know the sector is opening up. What kind of filter, the policy framework is going to put on who comes in will be interesting to see, but hopefully it's not going to be, and it shouldn't be, and I don't understand why it would be, anything that kind of compromises or restricts the kinds of banks that, I believe should be coming. The ones I mentioned. There's all kinds of issues, capital requirements. One of the things we shouldn't forget, and I'd be interested to hear from our friends from First Bank. So when you look at Ethiopia, and you've got this closed currency regime, it's not a business model they're familiar with. You can bring dollars, but you can't take them out. It's like, how do you manage that? Does that mean they're going to come in with the minimum capital requirement and then try and just mobilize funds locally? If we had an open currency regime, maybe they could use some of this capacity they have to raise money on the international markets. And if that money can make good money here and you have a free open capital account, maybe they could deploy a ton of money here because the margins here are so high. The market is so desperate for foreign exchange. I keep coming back to this thing. Liberalizing the foreign exchange regime, I've done some, I've put it there. Within a year and a half, that could generate $10 billion a year in foreign exchange earnings we don't have now. And that's really without pushing the envelope too much. So, as I said this morning, we need to move kind of quickly on that. It's not difficult. That's another topic. But until that happens, Ethiopia is not yes, you've got this massive consumer population. It's like, how do you do business? Are they going to come in and scrounge for deposits and fight everybody for deposits? You can't make those loans if you don't have deposits. Okay, the currency regime stops you from bringing cheap money in dollars and using it, taking it out. We have one very big attractive asset, this massive young, rapidly digitizing population, but we have this big wall that says, don't come, don't bring your dollars. So, this point I was saying about, the magic bullet for this economy is exchange rate liberalization, literally. And we have to do that. And anyway, it's at a point where it's unavoidable. I don't think it's even a choice, and it's coming. So anyway, with that, And let me stop here, open it up for comments or discussion. Noted.
So on today's paper, on the reporter, there has been a breaking news saying that the National Bank of Ethiopia is currently revising the banking proclamation to open it for the foreign banks. And at the same time, let me just read the article. The revision includes setting a minimum capital for foreign banks to enter Ethiopian market on a joint venture basis first.
Okay, so it will be very interesting how this gets interpreted. A joint venture basis is wide open. All it's saying is, okay, we're not going to let you start your own bank. So anyway, that remains to be seen, but the fact that it's in process. I would also think that, the banks coming in, especially in such unfamiliar and novel, kind of country and economy, would probably want to find the right partner. And also, this allows for a lot of things, the knowledge transfer, blah, blah. It addresses a lot of concerns, and probably not a bad policy. The minimum capital requirement is an interesting topic. So, okay, hypothetical questions. For example, on the telecom privatization, which is not really a good benchmark or analogous for here, telecoms is a monopoly business or oligopoly business, and you don't want to have, it doesn't make sense to have 10 operators. Banking is not. You want a competitive banking industry. You want a lot of tough players. Okay? So, does that mean you let any bank in the world who wants to come to Ethiopia come? I don't think so. You don't want too much confusion. Do you decide 5 banks, 10 banks, 2 banks? Okay, depends on the assumptions, the policy objectives, how you want to do this and do that. For me, I believe in letting markets make intelligent decisions. It's like, okay, I think I know banking, and I think I know the Ethiopian banking industry, and I think I understand the economy. If you ask me, how many banks should we allow? I have no idea. And anybody who says they do, I think is, doesn't. So how do you deal with this? Okay. If it was me, I would say, at a macro level, what kind of bank would we like to have come? Maybe, people agree with what I said. Say we want big, strong institutions who have established corporate governance, who have funding capacity, who are real banks, and who know how to operate in Africa, and who have a proven track record, blah, 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 blah. We end up with a list. Oh, then how many of them should we let in? I don't know. But I would let the market, I would set the bar for the minimum capital requirement really high. To me, that's the best screening mechanism. People that aren't serious about coming in, don't have a long-term commitment to this thing. When you make a big investment, you have to get a big return, which means you have to work. I don't know what the number would be, but I would set a minimum, and then I might even go as far, because we need the foreign exchange as well to come into the sector. I might put some number, I don't know what the number is, but really I wouldn't want to. If you really wanted to maximize Forex income, maybe even put some licenses up to bid. I mean, that's really pushing the envelope. But at least a sizable minimum capital requirement so that you don't get, whatever. Should we even restrict, once we have a very high bar, and what that is okay, you'd have to see, requires some studying. Would you even want to put a limit on, say, 2 banks or 10 banks? You know, all these market players, they're not stupid. You know, by the time you have 5 banks in, bank number 6 coming is going to look and say, well, you know, do I want to get in this dogfight? The fact that we create a dogfight, we benefit. Okay, the strongest will come out. And the weak ones, what happens? They don't die. You know, it's a bank. Maybe they get acquired. You know, maybe they merge, maybe they this, but that shouldn't be our priority. It's the fact that we have a banking service that's functional, strong, vibrant, responding to the market. So, you know, the modalities, who, what, where, I think we need to be very careful about trying to micromanage this and figure out, you know, just baga, you know, let the market do its work, and we'll get the right solution. So with that, let me stop and then open it up to questions and comments and discussion. Sylvester, you're raising your hand even in the middle of my presentation, so I have to let you speak first. Obviously, you're disagreeing with something I'm saying.
Thank you to Ermias for your wonderful and very persuasive presentation. You know, I was just going to make the comment about winners and losers. Something like this happens, and some people will win and some people will lose. And more often than not, is the market that is also going to propel whatever is going to happen. I think in Nigeria, let me also say welcome to the First Bank people. First Bank has been dead for more than 100 years. Great, yes. And for each successive wave of banking consolidation in Nigeria, they have survived it. And then there are also many banks that did not survive the banking sector reforms and consolidation. So if the regulatory agency, the National Bank, if they say, okay, we need the sector to consolidate, so this could now push many of the local banks to think about merging, to build their capacity and amalgamate. You know, even in Nigeria, some of the banks of the same generation have swallowed other banks. And one of the big banks in South Africa, ABSA, is actually Amalgamated Banks of South Africa. They have also swallowed other banks. So people should not be afraid of consolidation. If there is a consolidation exercise of the banking sector, then some of the banks will have to be forced to come together, build their capacity, merge their capital, raise more capital from the stock exchange, and be in a stronger position to take on foreign banks. So there isn't a problem, actually. Like you have rightly pointed out, the ones that will survive and become stronger, and the ones that will go. But at the end of the day, we also want to see Ethiopian banks branching out to Southern Sudan, branching out to Sudan, going to Egypt, you know, becoming continental banks themselves. You know, it's not other banks just coming to Ethiopia. Ethiopian banks should also be able to, you know, spread out, you know. So that is all I need to, that's all I want to say, that, you know, this could force mergers and acquisitions, and banks, new banks, stronger banks could emerge from this exercise. Thank you.
Just to follow on your point,
Yeah.
You know, I think there might have been some banks who might have asked to do business outside of Ethiopia.
Yeah.
I'll tell you a funny story. It's, you know, I've learned not to do silly things like this now. But, you know, when I was first setting up Zaman Bank, and I put in my application to the National Bank, in the business plan, I had a Washington branch. They thought I was dangerous. Literally. But the mentality is, you know, I'm talking 15 years ago.
Yeah.
It's like, you know, it's so upside down. What are we so scared of? We should be out. You know, CBE. Should be, you know, a long time ago, should have been an East Africa giant.
Yeah.
You know, whatever.
I mean, thank you very much. Just to create the actual context, again, borrowing from the Nigerian experience, in 2004, you had about 89 banks in Nigeria, 89. And the minimum capital requirement was about $16 million. A very aspirational central bank governor came in and said, you know what? I'm going to move the minimum capital requirement from $16 million to $220 million. Existing banks, if you can raise it, you survive. If you can't raise it, get acquired, get merged. And within 18 months, the banks in Nigeria shrunk from 89 banks to 25 banks. And the 25 banks had $220 million minimum capital requirements. That was a lot of money. Where did the money come from? Most of the banks went to the market, went to the capital market, did the initial IPO, got the money from the semi-economy. The ones that couldn't get the money got merged. Then I was a consultant. In fact, we had 10 banks come into one and formed a bigger bank. 5 banks into one. Banks like First Bank acquired 1 or 2 other banks, and you had 25 solid big banks. And suddenly, there was so much money to deploy. They were stronger, they could write big ticket transactions, and even the Nigerian market became smaller for them. And that was when the Nigerian banks started exploring the West African market and other African markets. Today, you have the Nigerian banks in East Africa, Kenya, Uganda, Rwanda, in West Africa, in Central Africa, in all the Francophone Africa, even in South Africa. So you need that trigger. Again, the central bank governor was seen as crazy. Why would you do that? Why would you move from $16 million minimum requirement to $220 million? It was a crazy aspiration, but the one thing worked. The president of that time was also crazy. He said, you go ahead. I want stronger financial institutions. And today, I mean, by and large, in terms of sophistication, in terms of product innovation, you can't take it away from the Nigerian banking industry. And that's again, it could be scary initially. People will lose. Some family banks, we had 89 banks, some were family banks. They were just there to protect their interests, the interests of the family, and they just have 3 branches, 1 office, just like that. But when it happened, they also had to raise their hands and say, we can't manage this. They just have 2% ownership in one of the big banks. And that's how we saw a market opened up. And again, that's what you're likely going to have here. I don't think there's any bank that died, just that they got acquired.
That's the point I'd like you to cover. Yeah.
No bank died, because you just need... They merged, they got acquired, so original owners got 2% ownership, 5% ownership, depending on what you're coming with. And the market moved on.
And even to meet the capital requirement, when you put all of these different institutions, they come with their capital.
Exactly. And they still went to the market, brought in capital. Some foreign banks even took stake in some of them, and that was it.
You know, I have a question for you. So one of the interesting features about the Ethiopian banking industry, also an interesting feature about everything we do, starting from our politics, you know, we have these ethnic banks, ethnic insurance companies, ethnic this, ethnic that. So, and then beyond that, you know, these banks were started 25 years ago. I regret I didn't start back then. The capital required when private banks were allowed, and I was here, was 10 million birr to set up a bank. It's ludicrous. Of course, 10 million birr back then, the exchange rate was probably 7 birr, 8 birr, so it's like a million and change. So small groups of people got together, and to a large extent, a lot of these institutions have big shareholders driving them, vested interests. So, and one of the things Kahali, okay, we want to advise on these kinds of issues. They've got this weird kind of character, what might make sense for the bank as an institution has these weird things that, like, they're tough to mix. When push comes to shove, of course, you got to do what you got to do. But one of the unique features of our banking system, our whole economy, is it's balkanized along these weird lines, which makes, M&A, these types of things, some are on religion. So, it's not like pure commercial entities looking out for their interests. Did you have anything like that in Nigeria, or do you know some other African country with a similar track record?
I mean, we had something of such in Nigeria. Again, there are some state governments that had banks, a group of state governments. So not so much, but again, it was regionally based states, or some states in certain regions have more interest. But at that point, it was a government policy driven. You either get into the fray or you just lose out. So most of the states, hands off. In fact, the central bank governor made a law then that no state government should hold more than 10% holding. And at a point, they said no state government should have holdings in a bank. So it was broken through a policy directive.
Okay.
And that was solved.
If I may just add to what he just mentioned, in Nigeria, they had like Bank of the North, African Commercial Bank for the East, and there are some banks that were, like ethnic-based in a way, but most of them could not survive. However, there is one that seemed quite ethnic, called Wema Bank, that managed to survive. It managed to survive. But some of the really ethnic banks, like Bank of the North, which was like for northern Nigeria, did not survive. Now, when there is a liberalization of the banking sector, is the market-driven strategy that is going to drive everything. So even if you have an ethnic-based bank in Ethiopia, it's the market that's not going to push them to say, look, an ethnic strategy is not going to work. Now, we have to change. We have to see how to survive the new environment that is coming up, and that just being a bank for a group of ethnic investors with a clannish interest is not going to work. So they will now the change will be forced upon them to change and adapt.
Yep.
And that's what happened in Nigeria. Yeah.
Thank you.
Let me just add a little bit color to what you have said so far. You see, and it's a bitter truth. You can bake a small cake and remain small, but you can bake a bigger cake and share it, and the proportion in which you will share it will be better than the small cake. It is much better for you to be a leg of an elephant. How many of us know elephant? That's our own logo. Than to be a leg of ants. 3 million years, a leg of ant will never become a size of a leg of elephant. So it's better for you to build a big cake. Ethnicity, when I was having my lunch, I was trying, somebody raise it. I said the problem for Africa is the same. Here is economy, here is politics. The two of them is like having a hot oil and you are trying to put water. Do you know the reaction? It will spark. And that is what the whole summary of what you are saying here. Whether it is ethnicity, whether it is religion, we have seen it in Nigeria. It got to a stage that what will be the driving force is the common interest. If we merge, what is my stake? What will I get back in return? It will happen. That is the market forces. It's natural. But I acknowledge the fear that you guys are raising. Maybe you want to do what the Ghana did. Do you know what the Ghana did? They have similar problem. We call them mushroom banks. In my days in JPM, you have less than $5 million. You are asking me to give you clean lines, unsecured limit. How come you don't have the strength? You are not big. I can't deal with you. You cannot even open a $10 million LC. If you open a $10 million LC, it's more than your capital. So maybe what Ethiopian can also do, you can distinguish that this is the class of the banks you want as a start. This is the minimum capital. This is what we expect you to do. This is our expectation in terms of value addition. You can spell it out, but don't allow fear to hold you back. I'm sure all of us have heard about Swiss canal in Egypt. Their former prime minister, they were this kind of a bottleneck. He said the era of autarky economy, closed economy, can no longer be held. That's what led to the privatization of Suez Canal, and they are making millions today. How will it be to move goods from Ethiopia, from east to west today? We have not even dimensioned this. We are only looking at the banking. It's just that the banking is pivotal to most of all these things. You are mentioning Ethiopia and Telecom. In Nigeria today, the main competitor, the main headache that banks are having is telecommunications because of this phone. They have license to do what they call it PSB. Because everybody is already on their data. They offer credits, cheaper rate than the banks. They are struggling. You said they've reacted just because they learned that Savary is coming. That is what will happen if you open up. So there are so many things that will kick off, but do not allow fear to hold you back. Honestly, you will regret it if you don't do it now. You will regret it because someone told me now that he can't buy my book on Amazon. That is not allowed. This is
currency regime.
They say it's not allowed. But what I'm going to do, just to let you know that I do the talk, I do the work. I have about 10 copies. I'm just going to give it out free. I said this book $20. But when 3 people said they want to buy, I said, go on Amazon. They said they cannot buy. You cannot buy on Amazon.
If you have a credit card with dollars or something on it, you can.
But how many have that credit card? So
Less
I
than
will
1%.
dish out 10. I will dish out 10 free, just to let you know the kind of benefit you will get when you open up. There's nothing you can claim that you know if you can't share it.
Save 1 copy for me.
I will give you 1 copy, then I will give, maybe because I always love gender, maybe I'll give 4 to ladies, 3 to maybe 2 to men. So please open up. Don't let fear hold you back.
Well, it seems we've made the decision. It's on its way. We're going to open up. The only question now is what kind of filters they put on it.
Yeah.
We'll see.
So define it. It's not for every Jick and Harry. Someone who could not run his country. A bank that could not survive in his country. That does not have pedigree of track record. Don't let them come. We've been in this business for 129 years. You can imagine 129 years of existing. So when we come here, I've given you the statistics, it's on bank. It is an average Ethiopians that are suffering all this economic rent. They are the one paying all this rent. But they will not know. Look at the picture that you have been showing here. It is painful. How can you charge 12% to open an LC? But the importer will pay because he knows that an average Ethiopian will not challenge the pricing. He's going to put it on his pricing, and they will pay.
That's why we have inflation at around 40%. Could you imagine if you have 40% inflation in Nigeria?
Our own inflation is also double digit, but it's not as high as your own.
Yeah. And that's more recent, not
14, 16, nothing more than that.
Okay, so let me open it up to here.
Thank you very much. Thank you for the opportunity given. And I really appreciate Ato Ermias for the nice presentation. My name is Hailu. I am from Addis Ababa. Just two questions for your reflection. The first is, in view of the capacity and the capability of the central bank to manage and control foreign banks, is it really timely to open up the market to foreign players? This is the first question. And the other one is, if you can give us your experience with regard to the experience of Kenyan banks in view of their proximity with our country. How many banks in Kenya did really flourish or vanish as a result of opening up the market to foreign players? The question now is not opening it up or not. The question is it really timely to open the market in view of the political, economic, social, and other factors that we are facing now? We know the balance of payment situation that Ethiopia is facing now. We know the inflation rate. We know how the export market is doing. So in view of these factors, is it really timely to open the market to foreign players? Just your reflection on these points. Thank you.
Okay. So I'll start with the first question. The fact that the National Bank has weaknesses and inadequacies cannot be a reason to have the whole country and the whole economy suffer. Number one, just my starting premise. Okay? Number two, who's coming? These are big international players who are institutions in a way that no institution in Ethiopia even exists. They don't break the law. They don't cut corners. They're way beyond that, okay? They operate in London and New York. They're not the ones that the National Bank needs to worry about. If anything, they're going to introduce a higher level of corporate governance, professionalism, ethics, blah, blah, blah. Number one. Number two, the nature of their business they're going after is the mass market. It's digital. What's to regulate? It's all digital. You can watch it. Interest rates, deposit, what's to regulate? Yes, we have our corporate banking sector now, as it is, with lots of issues I don't even want to get into, that the National Bank can't even, every time they put a regulation, no. The relationship between the National Bank and the commercial bank is adversarial. Doesn't do anybody, but the point is, that is a fixable problem. It's a people issue. It's a policy issue. You can fix it overnight. It is not an excuse not to bring in the foreign banks for two reasons. One, that it's fixable, and two, the people you're coming. If you say the minimum investment to come into Ethiopia is $300 million, you think that's an institution that's going to risk $300 million breaking regulations? No. So that's just, I hear it all the time. I'm glad you asked it. Irrelevant for me. Okay? Second point, again, it comes back to this thing about competition and what bank survives and what bank doesn't. The winners survive, the losers don't. And then we specifically talked about the Nigerian experience. What was it? What does it mean not to survive? You don't die. The shareholders don't lose money. You become part of a bigger bank. You own a smaller share, and you make more money. And you have a stronger institution. And you're serving the market better. You're competing better. The timing. Are we ready? We're so late, I can't even describe it. The current macroeconomic situation, all the more reason we have to do it. It's part of the solution to our problems. Our problem is that we're closed. There's no mechanism for money to come here. Why do we need financial infrastructure? Because that's the road on which money travels. It can't rain in our pockets out of the air. You know, there's things, financial infrastructure, that we need for money to come, the dollars that we need. And all of that comes with liberalization, not with closing. You know, we have this fundamental fear of foreign business. And it's really the sad legacy of many, many years of just living in a cave, literally, while the world has moved on. You know, we don't know what's going on in the rest of the world, and not knowing, it's natural, you know, the reaction is fear. As humans, we fear what we don't know. So, no, you know, you're asking for this, my opinion. On all points, every argument is we're late. There's no excuse that I've heard, legitimate excuse, that would make us question. Okay, let me put it very simply. How many countries in Africa have this policy? 2. Ethiopia and Eritrea. What more do I need to say? Pick any little country anywhere. Djibouti, Somalia, one of the most open, vibrant private sectors in Africa. The fact that they don't have a functional state actually helps them here. There's nobody to squash them. They have the best telecom rates in Africa. Why? It's a free market. They have 4 telecom operators, 5 maybe. You know, some of their banks are becoming regional. You know, these Hawala operations are becoming banks. So no, forget everything I was saying before. We're the outlier. Forget the world, even in Africa. So, I don't know. I think that speaks for itself. I'll come to you last because I already gave you a chance, but I'll come to you. Okay.
Hi, everyone. Thank you, Mr. Ermias, for all this meeting, and thank for this, give us this opportunity. I just have one question. We are foreign investors here in Ethiopia in the pharmaceutical business, and we've been suffering for a while with the banking system. And we are hopefully this bank things will come as soon as possible to help us with this our situation. But I have a totally different question than others. You know, like they are asking, should we open or not? My question is, why the foreign banks they are coming here with all these regulations? You know, like everything is closed. What the encouragement them for to come here? If they cannot give any dollar or, you know, like I ask for a loan for my banks and until they get approval from the central bank and the regulation and the bureaucracy, you know, like that by itself, it take months. So for like international or banks, you know, like this kind of things is very big problem for them to come here. They will not look only for just getting loan or something like this. They will go to be part with the banking system in general. You don't think that the first challenge is the banking system by itself, not only the banks? That's all. Thank you very much.
Well, I think they look at this banking system and the challenges you're saying, I think they look at them as opportunities. I'll let them speak to that. You know, gaps in the market are opportunities. So I'll let them speak on that. You know, the foreign banks coming, it's not going to fix our foreign exchange problem. Okay? What's going to fix our foreign exchange problem is foreign exchange regime liberalization. As you know, I've put 10 bullet points, in this Forum magazine. I've tried to boil it down, quantify it. Until we do that, it doesn't matter. We're not going to solve the foreign exchange problem. For corporates like you, let's say you have a banking relationship with a bank in some other country, and they happen to come here. In that scenario, maybe, they could give you birr loans, or even maybe foreign currency loans, because maybe, your parent company over there will guarantee the loan, or, whatever. Very, I don't expect a lot of that. They're coming here to play like a local bank. If the currency regime was open, then they would have a huge advantage because they can raise cheap money as long as the opportunity is there, unlimited. As long as they can show they can put this money to work and get a good return, that's all they have to show the markets. So, if we had an open currency regime and First Bank wanted to go raise $1 billion on the Eurobond market, and they could show that they could put it work in Ethiopia and show a really good return, but not with this closed regime. So I keep coming back to it. I said it this morning. Until we solve that, all of this liberalization is compromised. And our underlying economic problems will persist, whether it's inflation or having to print money and all of that stuff, and declining GDP growth.
Thank you, sir. I just want to bring to your attention to certain points. Number one, definitely policies will not be decided on the point of view presented in this kind of workshop. Therefore, you make another connection with policymakers and few well-experienced bankers, and then get the suggestions that they give before making all the points that are going to happen. In fact, it would be much better if you follow, I think it was the model of Telecom, which they were so careful that they took time to bring the attention to all experts and then decide on that. I think they did that also in the Ethiopian Airlines. I would suggest that this be taken in this way. The other point is, this reminds me one case in my lifetime. That is the case of structural adjustment. There was a structural adjustment that was pushed by the World Bank, and the only example that was brought to all the discussions was Ghana. Ghana was flourishing with the structural adjustment, and it was brought to everywhere as an example. After a few years, Ghana was the worst example of structural adjustments. So let us not limit ourselves to one example, but let us explore others. The other point is, I have lived in 4 governments. All my life, I have lived with the policy that has been given to me. Never agreed, discussed, or even happy with it. So we will receive it, whatever comes, and we will survive. We will survive. But it would be really good if you ask a question, which my friend at lunch asked me. What are the things that the current Ethiopian banks couldn't do that the coming international banks will do? Thank you so much.
Okay, thank you. I hear all your points. So, why did I decide to organize this forum? It's precisely to open up the debate. I take a very strong position, and I believe I can defend my position. With one, just economic theory and science, looking at the rest of the world and how we're over here, such an outlier. Then, just as a business person, I think I have the benefit of, being an academic, economics. I've studied it, I study it, I write on it. A banker, I started in banking 38 years ago. As an investment banker advising banks. In Ethiopia, I set up Zaman Bank, which basically changed the banking industry. So finance is really my field of expertise, and economics. And, it's not like this is like, it's not a technology, it's not a new emerging technology that we can't kind of figure out. All the pieces are in place to make informed, intelligent assumptions about how things might play out. Okay, the big thing is, especially in Ethiopia, a lot of policy is made with inadequate information, analysis, insight. So, we end up, as they say, with these camels with 4 humps. It's committees. And then we say, why didn't it work? It's like, why didn't our free market strategy when, after the Derg, why didn't it work? Improperly designed and, implemented. Why is our economy in the mess it's in now? It didn't happen by itself. It's the result of the policies we've been following and nothing else. And the solutions are quite self-evident and simple. So, when I take I've heard. And one of the reasons I wanted to have this conference is because all the media coverage I was hearing was negative. Don't let them in, don't do this, don't do that. And it's like, this is insanity. And the rationale that's presented, it's like there is no rationale. It's just an emotional statement of position. I'm prepared to defend my position. I've done my homework. To be honest, anyway, so I've seen some of the papers even presented to the committee that's supposed to be designing this policy. To be honest, I was saddened. We take case studies from 25 years ago. You brought up structural adjustment and the experience before. Is the World Bank, IMF crazy? It's like, is structural adjustment something that's wrong? No. There's a science behind it, but how you implement it, all kinds of issues. There's a price. Economics is, it's a science, but it's not a science. There's a million moving variables. Each situation is different, and you have to have enough local context to address all of that. So I think it's important to air all the concerns, really air them, discuss them, address them, and maybe, there's something that we pick up from that discussion. To say, okay, there's this particular issue here, and maybe we take the classical economic kind of framework or approach, and we modify it for this local condition. Okay? So, I'm here as an individual. I'm not a government institution or anything. I have a very strong view, which I think is based on a good understanding of economics and banking, and 26 years on the ground as a consumer of banking services here. So, you know, I state my position loud and clear and strong, and I welcome debate. And this is the kind of conversation we should be having with policymakers. And of course, you know, I know for sure there's gaps, information that, you know, any one of us is missing. And things change all the time, especially in the context we're in now, the macroeconomic context, as someone mentioned before. It's volatile. That brings in a whole other layer of complexities that need to be addressed. But all of this is not to argue, oh, this is too complicated, too volatile, too messy right now, let's not mess with it. That's certain death. The more problems we have, the more issues we have, the more urgent the need for action. When you act, is there a chance of making a mistake? Yes. But 100% certainty, not action, is bad. So, you know, I really appreciate, you know, strong opinions from the other side, but the opinions need to be backed up by, okay, 1, 2, 3, 4, this is why, as opposed to a general, and also keeping in mind the point of view, like I said, from an industry perspective, from a shareholder perspective, from a bank board perspective, you know, that would be a whole different view. But I always start with what's best public policy. No. So people who haven't spoken. So 1, 2, 3. Let's give these people a chance and then come back. Hold the note.
Yeah. Thank you. I just want to make some comments to frame our conversation with numbers and facts, right? So I was hoping you would address it in the presentation. So currently in Ethiopia, there are 20 banks operating. Okay. One bank being state-owned enterprise, the Commercial Bank of Ethiopia, of course, the Development Bank. Let's keep it aside. So the entire deposit currently in Ethiopia stands around 800 billion birr. 800 billion birr, right? So 500 billion birr of deposit lies inside Commercial Bank of Ethiopia. The rest 17 banks, private banks, being Awash Bank, the number one, having a deposit of 100 billion birr in deposits. Okay. So all these deposits comes from 35 million depositors. That's roughly 1/3 of the population. Okay. Okay. So these banks annually, combined together with the Commercial Bank of Ethiopia, 20 banks, they issue credits on average every year, 260 billion birr every year, credit. Out of this credit, the number of population or companies that gets this credit are 350,000 individuals out of 120 million people. Imagine, let that number sink for you first. I, as a young man, I don't know credit. Why? Because the first thing, when I go to my bank, I have a company, I have a revenue. When I ask them, I want a credit, they say, go Rotara first. But I am the 70% of the population. And that 70% of the population is growing every year, 2.5%. So every year Ethiopia has 2.5 million people turning 18. And they want a job. They want credit. For any economy, it's not a hidden science. For any economy, for any private economy, for any country, when economy grows, two things must happen. The central bank has to be independent of the government, at least in terms of influencing the decision. And second, the bank credit has to flow through each and everybody. That's why China is China. That's why Taiwan, Thailand, any other economy. And a country where you allocate, where you collect deposit from 1/3 of the society from 35 million, and he give it only for 300,000 people, that's like killing the country. And just to add on this, I think we have to also discuss this. We have 36 microfinance institutions. So every year they allocate around 68 billion per credit. And they allocate it for 5 million people. So roughly in Ethiopia, people who know credit is 3% of the population because of the microfinance. But the loan amount on average stands around roughly 3 to 5 million per. So that's what we're dealing with. So when we say, okay, Safaricom says this, when they come to Ethiopia, the reason they come is there is 120 million stories to tell. So our banks, any bank, when they come, they should not focus on the 1% of the 1% of the population. They should focus on the entire 120 million people and the many people yet to come. We always have to keep that in mind. That's the context we're living in. Thank you.
Thank you. Thank you very much, Marid. Actually, he crystallized the general point I was making. Just think about it. 35 million people, farmers, small, putting their 100 birr, 1,000 birr, 5,000 birr, 10,000 birr, at an interest rate where inflation is destroying it anyway. And then what happens with our banking system, the one we want to defend? It goes and it gives it to 300,000 people. But you know what? I would bet if we took the top 1,000 or 5,000 borrowers, that would be 80% of the money right there.
That's correct.
How in the world do we want to protect this? I mean, this point is enough. So thank you.
Thank you, Mr. Speaker. I come from a consultancy sector. And some 15, 16 years ago, Frederick Stiftung, the German development organization, financed a study project in Ethiopia. And I was involved with that. The topic of the study was, should foreign banks come to Ethiopia or not? So we put down a group of bankers and economists and accountants, and they conducted the survey. The findings of the survey was interesting. First of all, they discussed with bank managers. Then there were only about 10 private banks and 3 state-owned banks. The 3 state-owned banks, you know them now, they have all merged into one. The finding was this, that foreign banks should come, all of them. The bank managers, the bank board chairs, all agreed with this, but they just had a caveat, and that was, first, let them come as partners to local banks. But then, within a few years, they would go on by themselves without us. Why did they say that? We first questioned them, and they said, because we did not have the skill to manage and compete international banks. That was one reason that came out strong. And then we went to the government banks. Government banks obviously had to be quite evasive and had to say, well, the government is making studies and we'll have to wait for their decision. Our opinion may have to concur therein. So the idea of inviting international banks to Ethiopia was there at least 16 years ago. This is to say your attempt to emphasize this point now is well taken, but the bankers all along, yourself as a banker, must have been entertaining this idea for years. Now, the other study we made very lately, about 2 years ago, was about how a bankers association should behave, what it should work. The same company worked on that. So I'll go to the main idea I want to mention here, and that was we discussed with the government officials, the national bank officials, and we asked them, would it be wise to let in foreign banks to come to Ethiopia now? One interesting idea that came out strong from one national bank official was the following. He said, what happened to the brewery industry, to the beer industry? No, we said, this is what happened. API, was it this St. George Brewery? What's the name of the St. George Brewery owner?
BGI.
BGI, thank you. BGI has been working in Ethiopia for the last, I think, 20 years, maybe 25. And what has been happening in that company, they have been making hundreds of millions of beer by way of profit. And they were not allowed to take out that money in foreign currency. And what was happening? They have been keeping and amassing that money in their coffers. What happened later? They had excess money, and they had to buy local breweries. What happened? Raya went away to them. Dashan went to them, you know that. And very lately, Diageo, which is Meta, went to them. And the scenario was this, that the big banks coming to Ethiopia would swallow up the rest of the Ethiopian banks. And that would be a disaster. My humble question was, that would be a very good idea. Because if they sell, it is because they get more money, better money. And then they can go to agriculture. They can go to transport. I mean, these banks. They can go to other sectors of the society where there is gap, just like you said, because gap is an opportunity. They could go there and the economy is expanding. So the banking sector in a skilled and experienced company, a wise company, all right? And then the answer was, from the government official was, it's not time to let in foreign banks come in. Conclusion, because if they come, they will swallow up all the banks. And as I said, that may not be a bad idea at all. Thank you.
And, thank you so much. This is the tragedy of misinformed policy making. The analogy between the beer industry and the banking industry, it dies right there. But most importantly, why is BGI acquiring all these companies? Is BGI going around and saying, hey, I want to buy you? No. What's happened is all these beer factories that made massive investments are losing money. They can't take their dollars out. So if BGI hadn't bought them, they would have closed down. They're saving jobs in the beer industry. They're saving jobs in factories in the beer sector and operating at very, very low levels of capacity. Why? Because the consumer can't afford to drink beer anymore. Even with their limited production, when you look at the whole beverage sector, water, soft drinks, beer, demand is down. Okay, you have some big beer, big investments were made. And part of the problem is these big investments have big import requirements to produce the product. So they bring dollars, raw material, they sell, and they're building a mountain of birr. And there's a constant need of dollars to feed this machine. At some point they say, no. BGI acquiring these other beer factories is a lifesaver for the beer factories, for the investors, for the jobs, for the industry as a whole. And BGI is smart. They're saying instead of sitting on this pile of cash, we're long-term players. 5 years, 10 years from now, things will be right here. So even the analogy, I mean, it's just, anyway, thank you for bringing up the point. But the real point I take away from that is, how misinformed our policy making is. And hopefully now, what I understand, and the reporter article today confirms it, we're on this path. We're going to open up. So the debate is over, as far as I know. It's a question of when and how. Thank God. There was someone.
Thank you. Just 2 points. One is as a comment. How useful would it be to open up or liberalize the financial sector and the banking sector? Would not be, you will not be short of arguments in favor of liberalizing the market economy. The whole concept of market economy itself argues that liberalizing will be advantageous at the end of the day. But what I always miss is those arguments against the liberalization. I haven't heard of them. So I would have appreciated forums like this to have a balanced view of those arguments, which are, because whether in literature or any place, I don't just a simple fear. There are no factors, points which are mentioned, which are going to work against towards, opening and liberalizing would be difficult to the Ethiopian economy. That's one thing. But parallelly, what we should see and what the discussion should be, I believe, is those liberalized economies, most African economies, like our friends from Nigeria or other countries, what is happening to the economy? They've got decades of experience in a liberalized market economy, but the economic indicators are still not as good as that we think. So this narrative of liberalization will bring about economic development, may not be conclusive or might be misinterpreted unless it is backed by other economic factors. It's obvious that politics is the mother of economy, so unless we change the political system that will support production, manufacturing, service, everything, if they're not backed up by that financial sector liberalization by itself will not solve things. So the discussion after should be what will happen, what should be the lesson. Ethiopia has a late mover advantage. We have an advantage in terms of technology, and we have advantage in terms of learning lessons from other countries who have already liberalized the market. So these same countries have got high unemployment, high inflation, and everything. Just because we blame the closed financial market doesn't mean all these things will be solved. So the subject has to relate, and the real discussion has to start somewhere. Otherwise, we will open it, and then with such a panic, with nothing happening in the market, things will be bad in a very short time. As a good example is my company. So we are the first financial leasing company. We started to operate. So there are hundreds of millions of dollars, lined up to be invested in Ethiopia, just because the way getting them out or operating it locally has made it difficult, is becoming tougher. So, the fact that a little liberalization happens or somebody jumps in, it's not easy always to work on the platform. So the discussion should be what will happen after those companies started to operate, and then what will it will serve to the manufacturing sector, like the beer industries, the beverage industries. We've heard that one of the biggest beverage industries is also closing out because of raw material supply. So would that change, so the discussions and the liberalization, we should take advantage of opening it up in a way that we can maximize and taking the advantage of the others. Thank you.
Okay, so let me respond briefly. Number one, we're talking about economic policy, economic science. It's not some voodoo mysterious things. If you print money, it's going to create inflation. If you have an overvalued currency, you're taxing exports and subsidizing imports. Okay, lack of competition is never good, ever. The state has a role in taking off. After that, the state needs to back out. And there is a time from, free markets. There's a process. Free markets not properly regulated, not properly institutionalized with all the, free markets, it's based on assumptions that certain things are in place. Information is available and, factor resources can move, blah, blah, blah. Okay, under those conditions, there is no debate about that policy. It's science. But there is no country in the world, even today, that has a perfect free market economy because we're human and we have human economies, and there's cheating here, even on Wall Street. There's inefficiencies, blah, blah, blah. The fact that 5,000 people a day die from car crashes or something doesn't stop us from driving or flying planes. We will never have a perfect free market. Economics is always moving to equilibrium. There's so many variables moving all the time, you never have a steady state. And you adjust as you go along. That's why you need a good driver. But there is no way anybody can question that at the right time of growth, when an economy reaches a certain scale and complexity, there is no alternative to free markets. And the collapse of the socialist and communist era just proves it, period. There's one or two lingering at great price. So the fundamental economic policies we have are wrong and proven wrong by history and economic science, period. Okay, so for me, there is no counter-like argument unless it's misinformed. And there might be particular contexts where we have to watch out for this or that. If there was a strong, coherent argument for not opening up, we would have heard it. I would be speaking it. I don't have, it's not my religion. It's not my religion. As soon as I get a better idea, I'll shift. But this is what I know has worked. And, I keep coming back to, please, just look at we're like 2 countries in Africa who want to pursue this path, and we have the 2 worst economies in Africa. I mean, what more do you need? Why do I even have to defend this? It's that simple. It dies right there. We fear the unknown. And part of that is even our minds have been closed for the last 20 years. There is no intellectual conversation. There is no debate. There are no answers. I mean, there's nobody speaking out. So, we operate with what we know. And the world has changed in 20 years. That's why all the examples of, I read these research reports that are desk reports citing experiences from 20 years ago. Give me a current experience. It's a different world. In many ways, the global economy now is integrated and integrating. The African Free Trade Agreement is here. How can we even be talking about staying closed? We've signed to open up everything. It's not even a point of debate. I mean, that just shows how really far behind we are. We're coming out of the Stone Age, I'm sorry to say. These topics aren't even open to debate elsewhere. They're just fact. Okay? Is the implementation perfect? No. Can you have this go wrong? Yes. Can you have a car crash? Yes, because you have a bad driver or a malfunctioning car or whatever. But is the policy decision correct? Unambiguous, yes. At any time, it's never wrong. Once our economy is reached where it is now. We are choking because we've locked it. This foreign exchange liberalization, like I said, that's the magic bullet. Without that, nothing happens. Why are these beer factories closing and going? No foreign exchange. All our problems come down to this, in a large extent. So, that's liberalization. Above and beyond banking sector liberalization. So, I mean, you know, we're so far past this, we need to liberalize the foreign exchange. That's a big policy decision. That has more risks, macro risks, if not done right. I mean, that's where I would be very careful about how it's done. This is a no-brainer. I get loud without knowing it, sorry. I'm not angry. Sylvester, wait. Oh. I just want to make sure before I repeat. Anybody? Okay, one new person here, Sylvester, and then Hikmat.
I'm just trying to ask whether we have some empirical studies regarding these experiences which the Latin America and Asian countries had gone through while liberalizing their financial sector. Whether which modality works best for our context and what controlling framework we need to have in the central bank and other regulatory organs.
You know, yes, okay, you raise a good point. So, you know, we all have this nightmare experience of what happened with the Asian financial crisis when, you know, Wall Street went bust and all of this hot money, short-term money started running out of these East Asian economies, collapsing their currencies, blah, blah, blah. That was bad policy. Okay? When you're opening up the capital account, it's all money flows. Okay, they have what they call, you know, these short-term debt instruments that come in and out globally, managed by hedge funds and all kinds of people who are looking for the smallest margin. As long as the currencies convert, it's a huge industry on Wall Street. And that's what makes markets work. You have all of these people looking for imperfections in the market to make money, and that's what fixes the imperfections. So when a government has a bad policy of letting in too much of this hot money because it wants to finance something short term and this and that, you know, it's like they have to know what kind of risk that's bringing. You know, you can never predict an economy, you can never predict, even Wall Street, it crashes. Nobody predicts a crash. The economy is too many things going on and subject to shocks. So, yes, it's not about whether you open up or not. Then you have to take measures to make sure that you're not introducing, you know, too much risk of the kind of money you actually don't want. That's speculative money. And there's ways to, you know, without blocking it, making it financially unattractive. So, you know, I know what you're referring to. Like I said, you know, like anything, you know, I don't like to use simple examples. A guy who drives, you know, good driver, can he be expected to, you know, leave home in the morning and come back? A bad driver, you know, he'll crash the nicest car. Economic policy is like that. We know you have to start the engine, and you know we have to shift gears, and you know the fuel and the brake. That's how this thing works. If you put the gas when you're supposed to put the brake, you're going to crash. That's how you drive an economy. Okay? It gives you the tools and the vehicle But it changes day to day, week to week, month to month. And you have to be able to, A, know those. Part of a financial infrastructure is having knowledge for decision making. We make decisions without any information. It's like driving a car without a dashboard and maybe with a blacked out windscreen. So yes, these things have to be done right, but the path is, I think, beyond question. I think, just my opinion. Hikmat?
It's a rather a remark, it's not a question. I think opening up the economy is going to be good for the public sector reform. As you know, I joined the government from the private sector as a small regulator, and what I see just amazes me. So policymakers, including some of the big regulators like the National Bank, like I said earlier, human capital is an issue everywhere. So some of the policies, like you've said, is because of fear rather than based on knowledge. So I just wanted to say perhaps even the issue of corporate governance has not been addressed and not talked about at all. So we talk about a stock exchange without having addressed the, well, what is our corporate governance code in Ethiopia? Where does one go to get perhaps a list of potential board of directors if they want to operate in Ethiopia? And I'd like to inform the First National Bank that the National Bank actually micromanages how much the fees for the directors should be. So the limit is less than $3,000 a year. Can you believe it? So you can imagine the kind of directors that you have with so much responsibility as big as running a bank. So I think our issues are a lot, but I really believe that opening up will help the public sector reform, because we cannot continue having capacity at the regulatory level, and we can't regulate the market. Like, the capacity within the regulation is lower than what you're actually trying to regulate. So I just wanted to point out that I think it will be good for the public sector.
Thank you. Malaku.
Thank you for giving me the opportunity. I wanted to ask more of a forward-looking question. We've sort of gone over an argument that I think is largely settled because the government has announced it. So my question is, a year and a half from now, what do we think we will see in terms of how we that are consumers for the banking sector, could see changes? There's a saying in the about banking in general that I think is more true in Ethiopia than most other places in the world, which is that banks only give loans to those who don't need it.
Yeah.
And in Ethiopia, because of high collateral requirements and high interest rates, that's very, very true. So in the aspects of banking, what do you think we'll see when new players from abroad are operating in the country? And then the second part is the digital aspect, which we talked about this morning, but again, a year from now, we have Telebir, which is kind of robust at the moment. We have M-Pesa coming. We have Alibaba and cloud and e-commerce happening along with the artificial intelligence agency. What do you, with the combination of these things, what do you see in about a year and a half or so from now? Thank you.
So I'll take a guess at it. So this is actually something I've been looking at for the last, I would say 3 years, ever since, I signed an agreement way back when with Whale Cloud and the Alibaba Group. The initial project was to actually bring the cloud platform, because nobody was doing cloud here. But now someone is. And then the idea was we go into e-commerce and add financial. Bring that whole platform. And that was without any consideration to foreign banks coming in or not. Why is that? Because that's where the gap is. We've discussed the problem. And the whole world is just going digital. I have a problem kind of trying to compare any industry today with that industry 10 years ago. The fundament, 10 years ago or 15 years ago, who's talking consumer loans? It wasn't viable. Too expensive to go do this little loan and this and that and the paperwork and this. Digital, it's like zero marginal cost. So it's a whole different world, and all digital services and all business models now are consumer, mass market, whether it's entertainment, whether it's shopping, whether it's finance, whether it's transport. It's making everything digital, creating efficiencies, removing blockages in supply chains and whatever, and bringing hyper efficiency to everything. So that's the new world we're in. So I don't really buy comparisons to examples 10, 20 years. It's a different world. It's like trying to compare industrialization before electricity and after. What's to compare? Kind of thing. So for me, it's a new world. It's a digital world, period. What's interesting about the digital world is it's not very democratic. It doesn't allow for 10, 20 players. It's kind of a winner-take-all, most game. Unless you have balkanization in the infrastructure that stops you from covering, or if you have resource constraints, so on, banking. I don't care, you can bring all the technology in the world, but your lending capacity is constrained by your deposits. In big developed markets, no, you can raise money if you can make loans. Everybody's digital, so you can have a better deposit product, kind of what Ant Financial did in China. It's a 12, 13, 14-year-old company. It's now the most valuable financial institution in the world, that little, that ant that they started. It's worth, at the peak when they were going to do an IPO, before they, had some issues, it was valued at $450 billion. 10-year-old company, more valuable than any bank in the world. The top 2 banks combined, maybe 3. Why? Because they didn't have to count on deposits. They originated the loans and they passed it off to all the banks. So they had a model where they didn't have to have deposits. They just had to bring the customers, and they came between the bank and the customer. And they took their commission and they created this monster. In Ethiopia, a microfinance institution or a bank, as a bank, they could get all the customers they want, have the best product, the best pricing, the best technology, but they're constrained by the amount of deposits they can generate. And we know it's a dogfight to get deposits now, because monetary expansion has eased, there's more banks and this and that. Our business model would be, we want to be the front end, bring the consumer, offload the loans and this and that. So, with our economy and the constraints it has because of policy, including the foreign exchange constraint, which makes funding limited to local sources and local savings, kind of the exponential kind of winner-take-all, building an ecosystem and dominating the market gets balkanized because there are constraints peculiar to our market. So it's very hard for me to predict how this actually plays out on the ground. There's so many different pieces. And then most importantly, the regulatory framework. Are we going to liberalize the currency? In which case, the funding pool expands. There's so many variables going on. The only thing I'm sure of is the policy direction is right. Digital is the future. Including for, we're talking about individual loans, but a big part of the business is SMEs, financing SMEs. and being able to do that effectively. I mean, who's financing SMEs? Nobody. So I'm not sure if I've answered your question. There could be quite a bit of variability how to specific issues play out. But, you know, again, the big point is, this is digital technology is winner take all, winner take most. In the Ethiopian context, there are constraints that stop that. On the lending side, basically deposits, no capital markets, no alternative to raising funding. Maybe that, you know, capital markets is coming. Maybe it will change it somewhat. But the fact that we're closed, and even when we open up, being able to integrate into the global capital flows will take some time. So very difficult to be, you know, too confident in any one scenario. I don't know if I've answered your question.
Partially, although maybe one of the things that would be interesting to hear from the gentleman from First Bank, for example, is how do they see themselves entering this market, and what kind of new features, new services, how do you see yourself playing a part in transforming the financial industry here?
And feel free to disclose all your secrets. There's no banks here.
Okay, again, thank you very much for that question. The truth is this, it would depend on the policy direction and the level of openness that we have in the market. Again, borrowing from our experience in entering into other African markets, one thing we see unique here is the level of financial debt presents a strategic opportunity for a very massive agency banking. And that's one of the things you see in developing markets.
I missed what you just said. I didn't catch it.
So today, the penetration of financial services in the population is still pretty low.
Yes.
And that presents a very strategic opportunity for a robust and aggressive agency banking. Today in Nigeria, using agency banking platform, a bank like First Bank has been able to penetrate across all the villages and areas in Nigeria. Today we have about 180,000 agents across all the Nigerian cities, all the Nigerian villages. And on a daily basis, the kind of transaction velocity you see, and that is taking financial services almost to every corner. We see an Ethiopian market as a very ripe market because of the population, because of again, the geographical spread you have here. You cannot use the typical traditional bank to penetrate. Digital is very, very strong points to also use here. Today in Nigeria, I mean, I will stay here in 30 seconds, I'll get a consumer loan disbursed into my account. Just dialing few codes that will take less than 5 seconds. With the way we've liberalized lending and, in fact, consumer lending is something that we almost transformed the entire market. We do on a daily basis, if you put it in dollar terms, we do over $5 million. And the churn is very high. Imagine we profile over 10 million customers to access, just one bank, provide 10 million customers to access the consumer loan of up to $300. And is renewable every month, every time. Just access, and in under 30 seconds, you get it disbursed. It's not approved, because it's automatically approved through algorithms that have been programmed.
Yeah.
Again, imagine how that would turn into a country where you say the core banking system is only disbursing loans about 350,000. Only one bank provides up to 10 million customers. If you aggregate that, you see how it will be. So some of the the unique offerings that we have going in some of African countries, especially in Nigeria, we see them ripe for this market. But again, the market has to be open. If it's not open, there's really nothing we can do. If the institutional infrastructure is not there, there's so much any international bank can do. If the policy framework is not there, if we can't, today is pretty strange that the FX restriction here is so much that you can't do certain things. With your local Nigerian card, you can do international transactions to limits. And the banks make so much money because they've opened up everything. With a local card, not a foreign card, you can purchase things with a limit. So those, again, is the policy frameworks that will engineer the kind of things. But we see a huge market. We see both at the stage of development presents strategic opportunities, and there are specific offerings both from the non-traditional banking type of agency banking and even the core digital offerings we still.
I have one question for you, actually. Yeah. So how do you look at the corporate banking sector? Do you, in other countries, whatever, here, how do you look at, the consumer market is clear.
Yeah.
What's your view on that? What's the opportunity? Do you view yourself as a threat to the local banks in that regard? Would you go slow?
Again, I mean, in all the markets we've entered, we see the corporates being the big pushers. What we've done is, in fact, in one of the West African countries, we actually raised the game by helping the major oil and gas company access funds, huge funds from our counterparts in UK. So we use our subsidiary in UK to provide massive funding that could drive expansion. So the way we would play in this market is to enable the funding base of most of the corporates. So if you're doing a $1 million, we could actually, if we analyze that you have the opportunity to grow, we could do it X
but
times.
What's different here, until we change the currency regime, you bring those dollars, you don't take them out.
I mean, no businessman will come.
Yeah.
Forget about it. No businessman will come where you can't take your money out. There's really no, it's not a charity organization. Investors come for returns, and if you can't take your returns, there's no basis. That's the truth. Nothing will attract an investor to a market where you can't repatriate some of your...
Which is why, anyway, it's coming by the time, I think, the banking sector actually opens up and we have all of those regulations. Hopefully this closed currency regime would also...
yeah, it has to happen.
Yeah,
it's a major enabler. If it doesn't happen, yes, you will see French players coming to position. And again, also, if there is a promise that it will happen in the next 1 or 2, 3 years, yes, people will take a strategic bet. So all those will play. But if there's a view that is not on the table, is not going to be discussed, nobody will be attracted to come into the market. That's the reality.
Understood.
Maybe, if I may, I know for talk.
No, but you're giving us information, so actually, no, we give you all the time.
Let me give you an example. Ethiopian Airlines fly to Nigeria, sell tickets in Nigeria. How will you feel if Ethiopian Airlines could not take the sales out of Nigeria? Can anybody answer that question? Why is there sudden silence now? Come on. Salamo.
Yeah.
Salam, how will you feel now?
It won't come. It won't fly.
Okay, you fly to Johannesburg. You make huge sales. And the government of South Africa say you cannot take your money. Will there still be Ethiopian Airlines? Come on. Let us leave the veil. Please. Ermias.
I'm with you. Please, somebody.
Who will answer? Now, nobody wants to answer it.
Nobody
and
can.
yet, we are proud of Ethiopian Airlines because they are delivering. Other countries are supporting them. Or maybe I should even ask you, where is your top Ethiopian corporate guy? Let them go and set up in Ghana. Let them go and set up in Nigeria. You think that they will not be welcome? They will be more than welcome. Dangote has set up in Tanzania. Do you know how many employment he's providing? He will have chosen Ethiopia. From privileged information that I got, but because of this restriction.
Let me add one thing point. Dangote is right now is stuck with up to 5 up to 6 billion birr. They cannot take it out. They really cannot take it out.
So to answer your question, there are milestones, there are things that you will get, but don't let us deceive ourselves. If you don't liberalize Forex, it will not happen. We have passed through this. Somebody mentioned about SAP. This is not issue of SAP. I was in university, and that analysis about Ghana was not true. He's a strategic man. He has been with international consultants. We know you cannot use the idea of 20 years. It does not hold here. Yeah. Again, Alibaba. How old is Alibaba as a company, as an entity, compared to the one that have been around for 100th century? Don't let us deceive ourselves. The only thing that is permanent is change. Even change itself is not permanent. It's revolving. It's revolving. Maybe what I would just say in conclusion, if you can come up with some action point, and I love the way you put it, that you are ready for a challenge, that you are convinced. That's what Marcus Garvey says when he's fighting for the freedom of Africa. He has confidence. Some of the things we're enjoying today, maybe some of us need to do some historical research. And I really love your confidence that you are convinced. Put some facts. Let those who are on the other side, if they can come, and you have said it, for this transformation technology world, it's not democracy. You heard him when he said that we had a crazy governor. We had a crazy president. Those who are saying no, 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 then, they are the ones now saying, oh, you did well. You did well. Ah, what a lovely idea. What a lovely transformation. You cannot get everybody on your side. If you are waiting for everybody to come in, you're not going to start. I can assure you, you're not going to start. But take a little step. In fact, you have seen what you said Ethiopian Telecom did. That should be a signal to you. Don't wait for everybody. Unfortunately, technology evolves every second, every minute. So go for it. Go for it. Don't wait for everybody. I've given you my own honest opinion. This is my first time of meeting you. This is what I do when I go throughout of Africa from north to south to east to west. I've seen it. Until Africa can come together, we're just going to be the raw material of the world. How will it be when I'm leaving tomorrow at your airport? I see coffee brewed or coffee made in Ethiopia. I will be proud. I will raise my shoulder up. But rather you are sending it up. I've just looked at your external reserve now. It's less than $3 billion. That cannot cover 2 months or 1 month importation. How will you get more? When you are like this, if I fold my hand, nothing will enter. But if I release it, things will come in. That's what I'm going to leave you with. If you are Christian, go and read Bible. If you are Muslim, go and read Bible, it's there. If you are tight faith, nothing can come in. If you open it, things will come in. Thank you.
So, yeah, thank you to all the contributors so far. Why the focus has been on telecoms and banking is because the investment laws of Ethiopia had deliberately, blocked those areas for foreign investment. But then the agricultural development-led strategy, industrialization strategy of the country also put the focus on agriculture, and the previous government did not want natural resource extraction to lead the economy. So I keep saying that Ethiopia, potentially, like you corrected me earlier, potentially is the richest country in Africa. Now, this might sound strange to many people, that how would you say Ethiopia is potentially the richest country here in Africa? Let me take the case of Dangote Cement, where I did a proof of concept for them. I knew that they were importing a lot of coal from South Africa, and I said, oh, you can't keep importing coal from South Africa. There is coal in Ethiopia. But then the Ethiopians turned against me and said, oh, our coal is not good. I said, if you don't use it, who is going to use it? The people in South Africa are never going to come and say they want to use Ethiopian coal. You have to use your coal. For whatever it's worth, that is what you have to use it. So at least I can take credit for the fact that we have been able to, at Dangote, get some amount of local coal utilization, and that has reduced their foreign currency requirement. Now, why am I citing this? After telling Dangote Cement that there is coal in Ethiopia, I had to go myself to live in Jima for about 1 year, and then went again to Benishangul and lived there again for another year, because I didn't want them to think that I deceived them, that there was coal. So I had to go walk the coal myself. Now, in the process, I now discovered everything that is out there in Ethiopia. All the mineral resources, everything. It's not here in Addis Ababa. So if we are opening up the banking sector, we should open up other sectors of the economy, especially natural resource extraction. Iron ore is not touched here in Ethiopia. And the dollars that we're crying about, we are using it to purchase rebars for construction. Meanwhile, if we had iron and steel in Ethiopia, then we'll reduce our foreign exchange consumption for importation of steel. Strategic minerals, lithium, nickel, copper, all these things that are going to drive future economies, Ethiopia has all of them in abundance. Tantalum, cobalt, everything. People should go out there and dig out whatever is in the land of Ethiopia. Because even telecoms and banking can only take the country so far. The country still needs to expand its economic base, its productivity, its GDP, and it's not only banking and telecommunications that is going to offer that. You know, so your solid mineral resources, your extractive industries, and all these things have to be tapped into, because the banks can now fund those things, those areas, and those areas will expand, and then that is what is now going to generate the economic growth that everybody is looking for. So it's not just banking and telecoms. Banking and telecoms, yes, because these are enablers. But then the real wealth of the country is buried out there in the soils of this country. So we have to also look at those areas to tap them. Thank you.
I agree with you. So just as a closing comment to add to that, you know, why do you have these vast areas of opportunity go neglected? We don't have financial infrastructure to identify them, finance them. You know, financial infrastructure, I always say, I use the body as an example. Our bones are the hard infrastructure that keep us up. Roads, power, telecom. The muscles are our social infrastructure, legal system, educated population, healthcare, institutions. The most important thing, the brain, the circulatory system, the heart, it's the financial infrastructure. And this is the one thing we've neglected. So how do we expect? There is no brain to figure out where the money should go. So you end up with 150 water companies when 10 will suffice. 50 paint factories On and on and on. No brain in this economy. No financial infrastructure in this economy. So, I mean, it goes beyond, yes, banks, stock exchange, FX liberalization, but it's the whole ecosystem. Being able to mobilize funding, being open, being able to access international finance. You need the whole system in place to make it work, and hopefully we're on that path. And then we don't have these conversations. Anyway, so thank you so much. I think it's enough for a day. Yep.